You can choose to travel by car, bike, or on foot to your destination, each with its own benefits in different situations. Similarly, on wealth accumulation journey, it is important for you to find the financial plan that suits your needs in different economic circumstances. With supply bottlenecks persist, high inflation denting consumer confidence, and tighter financial conditions, the global economy may continue to slow in the coming months. The global growth rate is expected to settle at about 3% in 2022. Among major economies, we are more pessimistic on Europe. With high inflation, the era of negative interest rates may end quite soon. If the Russia-Ukraine conflict drags on, the probability of a recession before the end of the year may rise rapidly. The economic growth rate in the US may slow to below the long-term trend in the second half of the year. However, supported by relatively high levels of savings, consumer demand and business investment, the US economy may be more resilient than the other developed markets. Our base case is that recession risks may not rise sharply until the second half of next year or in early 2024. While oil and food prices stay high, the decline in inflation is expected to be extremely slow. Before the end of the year, the US CPI may only fall slightly to about 6%. The Fed may continue to hike quite aggressively to fight inflation. Benchmark rates may reach at least 3.25% by year-end. Economic data in China had begun to improve recently, and the economy is expected to improve in the second half of the year. The central government may continue to accelerate the intensity of economic stimulus measures. Compared with conventional monetary tools, the central government may focus on the fiscal policy tools or supportive policies for individual industries to stabilize the economy. However, with the risk of a resurgence of COVID cases, if China's zero-COVID policy remains in place, the economic growth rate may be impacted negatively again. Coupled with weakening external demand, the full-year growth rate may fall short of the 5.5% target. Unexpected situations happen all the time. Taking precautionary measures in investing and biking may reduce risk. As the market has accumulated some losses, there is a chance for a bear market rally backed by extremely oversold in the markets and relatively reasonable fundamentals. However, once the economic data turns distinctly worse and recession risks rise sharply, the stock market may pull back significantly again. Overall, we remain a neutral stance on equities. Among them, we are slightly bullish on Asia, Japan, and Hong Kong, while neutral on the US and China. We are slightly bearish on Europe. For the third quarter, we remain neutral on fixed income overall. Although valuations are relatively reasonable, the Fed may not be able to slow the pace of policy tightening in the short term. Real rates and overall bond yields may remain high in the third quarter. Our view on sovereign bonds is neutral. As for investment-grade bonds, even though total returns may be affected by higher bond yields, backed by relatively solid corporate fundamentals, our view is neutral. It's a long way to accumulate wealth, and you may go through many ups and downs. With us working together, you will have more time to enjoy the scenery along the way and enjoy your retirement life.